let's take a look at this stable wholesale and e-commerce party supply business making $2,300,000 a year in profit and listed for sale at an asking price of $10 million. I'm going to go through this listing here and talk about some of the key details and talk about the factors that matter in valuing this business, some of the things you would want to consider or find out pretty quick if you're interested in acquiring this business, and ultimately share with you my quick take on this business's valuation. Let's just start right here with the established date, 1990. I'm recording this on December 10th, 2025. So this business is about 35 years old, and it's doing $7 million a year in revenue with $2,300,000 of EBITDA. We'll talk about the EBITDA in SDE in a second because there's a little bit of discrepancy there, as I'm going to point out. But $2,300,000 a year of profit, that works out to a margin of a little over 30%, which is a pretty healthy margin for any wholesale business in general and any e-commerce business, yet alone one in the party supply business, which is one where I would expect margins are relatively thin. Okay. So as we come down here, right off the start, we can see the discrepancy in the profitability numbers. They say $2 million in seller's discretionary earnings and $2.3 million of EBITDA. That is a little odd to me because in most small businesses, the SDE number is higher than EBITDA. So maybe they've got something mixed up, and then up here they've got SDE of $2,300,000, whereas down here in the description they've got it at $2 million. For the sake of discussing this listing here, we're going to be talking in terms of $2,300,000 of profitability. If you were interested in acquiring this business right off the bat, as soon as you got the SIM confidential information memorandum or whatever other information the broker provides to you or whoever's listing this business, I don't know who's listing it, but once you got the information after signing the non-disclosure agreement, you would want to flesh out how they're arriving at these profitability numbers here to do a proper analysis. Going on, it says the company operates through multiple profitable channels, including wholesale distribution, walk-in retail, and e-commerce, with a complete management and operations team in place, and they describe it as a turnkey operation. The asking price of $10 million includes $7.5 million of inventory. That's very important. We're going to talk about that as we get further into this. And they've got a diversified customer base with no high concentration risk, multiple sales channels, including wholesale, retail, and e-commerce, experienced management team that is fully operational. Substantial inventory included minimizes initial restocking needs. E-commerce channel outperforms Amazon in key demographics. I find it interesting how they kind of conditioned it on that. 200% plus return on investment on online marketing spend. Growth opportunities. Significant expansion potential exists across all channels with capacity to scale to $20 million in revenue. The e-commerce division shows exceptional growth trajectory with a skilled manager driving consistent monthly increases. Established wholesale and retail channels provide immediate opportunities to introduce new products and expand wallet share with existing customers. The party supply industry demonstrates recession and inflation resistance. I just find that quite an interesting statement or observation. I've never thought of this industry in context of recession and inflation resistance, and maybe that is indeed correct. People are always going to keep throwing parties. Their facility is leased in Los Angeles County, and they've got 20 full-time employees. And as we know, included in the sale, that $10 million asking price is $7.5 million of inventory here. All right. So let's flip on over to this screen here and talk about the factors that matter and ultimately the bull case on the business's valuation here. First up, inventory. We got to know what's going on with inventory, as that is something that I would typically add back in or add to the valuation of the business after assigning a multiple and multiplying it out over its future. So that's forecasted income or profitability of the business, right? So when we look at the cash flow or the profitability metrics, this is what has been realized by the seller. The business should be valued on what is expected going forward. Okay, we'll talk more about that in a second, particularly the inventory. And before we move on, I just will say that the $7.5 million of inventory seems very high for this business, especially considering what it does. So $7.5 million of inventory, that is more than one time their annual revenue. We don't know if this is wholesale cost or book value. Book value or retail cost. Book value being its wholesale cost, what they paid to get the inventory. I'm going to assume that they're listing this at retail just because this number seems very high, and I don't think that that is the proper way to value the inventory. All right, next up, what is the revenue split between wholesale or e-commerce? Okay, they talk about the business here being wholesale and e-commerce. They talk about this being a wholesale and e-commerce business. We'd want to know the split between those two, but then they've also got retail. What is the split between all of them? This is particularly important as we come into the next point here, which is the margin sustainable? I pointed out that the margin of a little bit more than 30% here, probably about 33%, is very high for a party supply business, particularly one that is in the wholesale and e-commerce space. Retail party supplies, I would assume, get a much higher margin. Right, so they're likely getting a higher margin on the walk-in traffic that's coming through the retail store, right? They buy, the party supplies from China at a very low cost. They mark it up 10x, and retail customers buy it. But that likely would not happen with wholesale or e-commerce. So ultimately here, as a buyer of the business, or when you're evaluating the business, you gotta smoke out how much of the revenue is coming from each channel and what the margin is on each one of those things. Because, if this business is ultimately generating substantial profits through its retail channel, it is not a wholesale and e-commerce business. Right? It could be that the retail products get a 75% margin, while the wholesale and e-commerce get much lower, like 10% from wholesale, 20% on e-commerce, but a substantial portion of the revenue is coming from that retail. Right? That changes things. This business here is going to skew on the lower side of the valuation multiple range. And then, what has been the trend in revenue? Right, is this business trending up or down in revenue and subsequently profitability, assuming the margin is staying stable? They list it as a stable party supply business, but it would not be unreasonable for them to describe it as stable, whereas in the last year or two, they've experienced a 10% decline in revenue and subsequent profitability. That's important, very important, because ultimately the valuation multiple would be assigned to or multiplied, would be assigned to the business, unit as a whole, but multiplied over the future profitability here. And finally, how many employees do they have? We know that it is 20, okay? So you've probably already noticed the multiple range here for a business like this, one that's doing $2,300,000 a year, engaged in selling party supplies, would be a 3 to 5x valuation multiple assigned to the business and multiplied by the future income that it's expected to produce. But that is a pretty wide range. We would also add inventory, back to that. All right, so let's talk about the bull case here and look at some examples. The bull case is that this business is substantially wholesale or e-commerce because that as a business model, wholesale and e-commerce is much more scalable than retail sales here, right? To kind of scale with retail, you have to open more locations and hope that the locations perform as well as the one you have. It is not uncommon to see a retail location in one area that does very well, and you open up another location somewhere and it does very poorly. You see this in franchise businesses where you get a lot of data on a lot of locations, Some of them will do exceptional, some of them will do very poor. So, scaling through this is difficult and capital intensive because you got to find the locations, set them up, get them stocked, but it's also risky in the sense that you don't know how they will perform. So ultimately here, the multiple would, lean much higher if this business is substantially wholesale or e-commerce. Then we'd want to look at the stability of the margin, right? Has this margin persisted? Has it been this high 30% margin for several years, roughly 5 years or so? If it is not, that would kind of skew it down on the lower end. Revenue trending up is certainly going to help things. And then let's talk about the owner involvement here. Ideally, with the management and team, the owner doesn't have an office on site, and the employees really don't know who the owner is other than a couple key employees. That would tilt this business's valuation towards the high side. Then I've got growth plan down here. This really, though, ties in with what is this business model here? Is it fundamentally wholesale or e-commerce, or is it retail sales? Again, retail sales would be the negative. That would be the bear case. The growth, or the bull case here would be that, there's substantial growth realized through wholesale or e-commerce. And that is because these are scalable. They can be fulfilled using the current infrastructure that they have. They don't need any further locations or capital investment. All right, so let's just kind of run some scenarios here. Let's just say that the business is substantially wholesale or e-commerce, but not entirely, right? So let's just say it's generating roughly 70% of its profit through the wholesale or e-commerce channels and 30% through the retail location. So the retail location is making a significant contribution, right? 30% of this $2.3 million is more than $600,000 a year to the profitability, and it's needed. But the wholesale and e-commerce is a robust and substantial business unit on its own. In that case here, I think the business would fall, kind of in the middle of this valuation. And we would just say that the multiple assigned to the business unit would just be a 4x, roughly a 4x, okay? Then we would ultimately need to factor in forecast what the income of the business and profitability of the business is going to be going forward. And let's just say that the business is in a slight or stable. Let's just say it's stable. Last 12 months, it's grown 4%. I would say in that case, it is fair to assume that under new ownership, it is going to stay about the same and generate this $2,300,000 a year profitability. So we will just use SDE $2,300,000. Okay. And then we have got this inventory thing. Now, they say $7,500,000 of inventory, but we don't know if that is the wholesale cost, which is also book value, or if that's retail. And like I said, I believe this would be retail, but you'd ultimately want to find that out and use the book value or wholesale cost in the valuation of this business. And let's just say that, that is like $800,000 in book value. If we use that $800,000 here, that values the business right at $10 million. And, the business is listed at $10 million in asking price. I did not intend for that to happen. I did not know that this number in the example I was going to use was going to arrive right at the asking price. But assuming everything, is in line with the assumptions I made here, the business is valued right at a fair valuation. And just to kind of go back through the assumptions, again, that assumes that it's 70% wholesale or e-commerce, 60 to 70%, 30 to 40% of retail. The owner doesn't have an office on site, and the revenue is stable. And subsequently, when I say revenue, that's implying that profitability is also stable because the margin would be stable. Now, let's just kind of change things up. Let's just say the owner does come on site daily. Okay. The split is still the same between wholesale and e-commerce, but the seller does come on site daily, and profitability and revenue, I'm just going to change this here to say profit and revenue trend, is down 10%. And also the margin is not so stable. It was much lower in years past, but they have recently grown their wholesale and e-commerce side. Okay, so they've been shifting to more of a wholesale and e-commerce. Retail's dying a little bit. Overall, the revenue and profitability is down 10%, and the owner has to come in on site. Well, going forward, if it's trending down 10%, you're not going to get that $2,300,000 a year of profitability as the buyer of this business, assuming you don't make any changes. So this number, needs to be adjusted for what you are likely to realize in the future 12 months here, assuming you make no changes, right? So it's going to be reduced 10%. And considering the volatility of the margin and the owner involvement, a much lower multiple would be assigned to the business unit here. And let's just say that that is roughly a 3.3x valuation. If that is the case, a realistic fair value that this business would trade at would be about $7,630,000, which is lower than the asking price here. So that is my take on the business's valuation here using two assumptions. We don't know the assumption. What is your take? Is this business fairly valued here? Are there, other things that you recognize in the details that maybe I didn't, or maybe you know something about the party supplies business? If you do, or you feel like there's anything I overlooked, I'd certainly love to hear from you. Let me know in the comments below. And if you found this video helpful or insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off on that note.